Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be providing tonight's topic, which is titled this week, Why You Need Secret Number 5 in This Volatile Market. Before I get into secret number 5, let's talk about the 7 secrets to making money with VectorVest. Our founder and mentor, Dr. Bart DiLiddo, created and presented the 7 secrets to making money with VectorVest many times over the years, and I was honored and privileged to be able to witness many of those presentations, and it's always a powerful and educational experience. I urge you all to watch a special presentation that was conducted by my friend and colleague, Mr. Steve Chappell, back on December 27th of 2019. Before I get into Secret 5, let me just show you how you can do that. From the home page of VectorVest, if I go to the Views tab, it will bring me into a menu that allows me to choose Strategy of the Week. I simply scroll down to the date shown, double click on that, and it will take you at the bottom of the strategy section to the link to get you to the presentation. So I strongly urge you to watch that for a very powerful overview of just how VectorVest will help you make money. So the secret I'd like to focus on here in this presentation is secret number 5, which is learn to trade options. First, we have to understand that the flexibility and versatility of options is endless and it's invaluable. Some of the specific things we can do when we learn to trade options is number 1, they provide you leverage, which I'm going to illustrate here in this presentation. It allows you to reduce risk by having less capital outlay. It lowers your costs when you understand how to use options such as selling covered calls to lower cost basis on individual stocks. You can also generate income in many different option trades, selling credit spreads, selling covered calls. There's many ways to generate income. And then finally, what I'll also talk about here is it does increase alternatives. And specifically what I'll talk about here, it is a great alternative to selling short in a downtrending market. So the beauty of options is you can profit whether the market is moving up or down, and I'll talk about that here in this presentation. But the key is they must be used properly. So if you're listening to this presentation, you may have more experience as an option trader or you may be brand new to it. I'll address the folks who may be new, and I'll tell you that my experience has showed me that a lot of folks, when they start trying to learn options, get intimidated by all the terms, all the definitions, all the theoretical things that go into options. It becomes very difficult to understand, and it can become overwhelming. So I want to talk about that for a little bit. For those who may be more experienced, we'll get a good review of how an option works. So it begins with calls and puts. There are only 2 types of options. There are call options and there are put options. And for those calls and puts, there are buyers and sellers. The most complicated, most advanced option trade is built around this idea that you can buy or sell a call, and you can buy or sell a put. Once you understand the concept of that, there's no option trade that you can't take part in. We have a table here that we believe is helpful to kind of lay this idea out, this concept of buyers and sellers of calls and puts. Let me start by defining what an option is. Number 1, it is a contract. It's a contract with strictly defined terms and conditions. It's also a security, and it trades just like a stock. It has a bid price and an ask price, and it has market makers who are out there who are tasked with the responsibility of providing a fair and orderly market. So keeping that in mind, let's start with calls and puts here on the left, and then we have our sellers and buyers. I'll start here in the upper right-hand quadrant here. We'll talk about buyers having rights. So if you're the buyer of a call option, you have the right to buy 100 shares of a stock at a certain price by a certain date. Those are the strictly defined terms and conditions. In other words, the strike price, where you strike the deal, and the expiration date, which is when that option no longer exists. So the buyer of a call pays money. For paying out that money or that debit from his account, they acquire rights. Now, if you're the seller of a call option, you get paid, but always remember you don't get paid for nothing. You take on obligations. And as the seller of a call option, you are now obligated to sell those 100 shares of stock at a certain price by a certain date. So just another note on a call option. So the buyer has the right, where the name call comes from, is you have the right to call away the stock from the seller of the option. And so it's important to understand the difference between the rights and the obligations. Now, on the put option, the buyer of a put option has the right to sell 100 shares of a stock at a certain price by a certain date. In other words, he has the right to put that stock to the seller of the put option. And so conversely, the seller of the put option has the obligation to buy 100 shares of a stock at a certain price by a certain date. And just to wrap this up, for a little added color, if we look at the bullish trades, this green arrow going to the upside, it tells us that the buyer of a call option is placing a bullish trade. And conversely, if you're the seller of a put option, okay, and you're putting yourself in the position that you may have to buy that stock, you also better be bullish on the trade. And then finally, on the bearish trades, the buyer of a put is bearish, and the seller of a call option would also be considered bearish. Let's talk a little bit about providing leverage. Margin accounts provide basically a 2-to-1 leverage, right? The only way you can use leverage is through a margin account, borrowing money from your broker. And what that does is increase both risk and reward. So yes, you have more money, you have more buying power, but with that does increase risk. Now, options can provide up to a 10-to-1 leverage and can reduce risk when used properly. Towards that end, what I'd like to do is just take a generic theoretical trade here on XYZ stock that's trading at 129.73. And I want to compare this buying a stock to going out and buying the right to buy 100 shares of that stock. So if XYZ is trading at 129.73, you go out and you buy 100 shares. Now in this case, let's take a look at what might have happened. Well, the stock went up, and just about a month later, we bought that in early February. About a month later, the stock had risen to 139.79. That's a 7.7% increase. Did what we wanted it to do. Great trade. Let's compare that, however. Now, we determined we're bullish on the overall market. We're bullish on the underlying stock of XYZ. It's trading at 129.73. But instead of buying the stock, we want to buy the right to buy XYZ at $130. You buy that one call option. Because you paid a debit, you now have the right to buy XYZ at $130. More specifically, your one call gives you the right to buy 100 shares at that certain price, which is $130, by a certain date, which would be the expiration date. Placing that trade in early February would probably be somewhere around April or May. So your one call in this theoretical trade costs $3.65 per share, or $365 for one contract that controls 100 shares. So once again, remember, in this case, the stock did go up over the next roughly month up to 139.79. Let's compare owning the stock versus owning that one call option that we talked about. So we'll start in the top row here, that 100 shares. If we bought the stock at 129.73, that would be our cost basis, $12,973. At the point we marked on our graph, the value of that position would be $13,979, which would net you at that point a value of that position, a profit of $1,006, which was 7.7%. What if you had gone out and bought that one contract? Remember, $365 is what we said that the outlay was for that one contract. The value of that contract would have been $1,080 on March the 1st. The net profit, now dollar-wise, it would have been slightly lower than the $1,000, grant you that. But here's the key. Here's really the picture, the definition of leverage. That's 195% return on your investment, okay, for just $365. And then I've added here, you could do 3 contracts. You're still only laying out roughly $1,100. You've got a $2,100 profit. That's what the position would have been worth. And then if you're really confident and you go out and say do 10 contracts for $36.50 is what you're risking there, you'd have over $7,000 profit, still 195% return. So that really is the comparison of the power of leverage when you talk about buying shares of a stock versus owning contracts with the right to buy that stock. Let's take a look at a more kind of a direct example here. So let's use leverage to profit in a rising market. I've chosen Chevron as my case study here. Now, we understand the volatility that's going on in the market. We know that we are certainly in a bearish trend. There has been up days. Overall, the market has been on a downtrend. But you know the old saying, there's always a bull market somewhere. And the power of VectorVest allows you to find those sectors and industries that take advantage of these headwinds that we're in. And so that's why I'm using Chevron here. If I go back into the program, I can take you into the Unisearch tool. And what I've done here is just to give you an idea of the power of the Unisearch tool in VectorVest in any market condition. I can look for industries and sectors that are performing the best. In this example, I just chose the delta searches for the price. So this is the 10-day rate of change for the price of the average stock in the sector. I ran that back on February the 1st, right? I chose that date kind of as a random date. With all of the geopolitical headwinds, the inflation, whatever else was going on, Ukraine and Russia and the oil industry, oil prices were rising. So it only made sense looking at headlines every day and understanding the macro view of what's going on, following the VectorVest views. I can easily come in here, run the price delta, and petroleum comes out on top. It's the #1 RT ranking of the sectors that we track. There's always a bull market somewhere, and here's where it was. Now, through the VectorVest program, you can go through, there are 20 different choices I could have chosen for petroleum stocks based on this movement in the market. Okay, if I go into a graph, I can share with you the petroleum sector. This is what the petroleum sector was doing at the time. Even though the overall market was in a downtrend, the VectorVest program helps us find that. We can also find these on the home page simply by looking at the gadget here, our top RT sectors, top RT industries. Again, as we speak, petroleum is still at the top of that list. So that's the basis for my case study here to show you how to profit in that rising market. I've taken from our Options Pro software from the Options Replay screen. It's basically a back test that we can use to show the results of combining the power of VectorVest with the power of leverage using options. So in this case, we went out and we bought one Chevron April 135 call on February the 1st. Okay, February the 1st, we paid $5.75 per share or $5.75 for one contract. Okay, now I could have, gone back here even further and showed even bigger profits here, but I want to show you a realistic scenario on how you can profit using options. So here we're able to, again, break this down. We bought the April 135 call, and this is the closing price on February the 1st, $5.75. Now you can see here that I marked off just, or about a month later, it's about a month later, this CVX option, Chevron option, is trading at $21.23 per share. That's a 269% return on investment. Okay, we can go out further just to give you an idea. 2 weeks after that, with Chevron trading up around $170 a share, had you held on to it, $36.83 per share, that's 540% return on investment. Anywhere in this run here would have been a great trade, a great use of the power of leverage. And then ultimately, if you had held it to expiration, which our risk management techniques would rarely have you doing, you would have had about a $3,000 profit. So just an example in the current market, in this volatile market, why secret number 5 is so important. Let's talk a little about using leverage to profit in a falling market. The case study I'm going to use here are the Qs, or this is the ETF that tracks the NASDAQ 100. Let's go back into a graph. If I come into a graph here and I can go to the market timing graph, and we can get a sense of what the market was doing if I add confirmed calls. Right, the one I generally go back to is all the way back in November of 21. We had that one whipsaw and a confirmed up, but I'll come to the most recent confirmed down, which occurred on April the 12th of this year. I said earlier, one of the powers of options is that you can profit in a downtrending market, and buying put options allows you a great way, or a great alternative to having to go out and try to short something like the Qs. Okay, so that's what I'm using here in this example. So let's take a look. I've taken again from Options Replay a similar case study here using that April 12th confirmed down call. I could find an individual stock I may be bearish on. I like to do them on the major indexes, the SPY, the Qs, IWM for the smaller cap stocks, DIA is diamonds for the Dow Jones, or you can do this certainly on individual stocks. But in this case, we went out and bought one May 340 put, right? It's basically an at-the-money put option, and we can see what happened afterwards. We paid $12.45 or $1,245 for that trade. Just a month later, whether you're doing this to profit in a downtrending market or to hedge perhaps an equity portfolio that you may have still open, but in any case, this put option is now trading at $48.45 1 month later. It's a 286% return on investment. Right? And anywhere in this range would have been a wonderful return on investment, again, whether it was a hedge or a trade to profit from. And then, of course, had you held to expiration, you would have hit its peak right at about $3,800, almost $3,900 profit. Okay, so these are the scenarios, and just a brief illustration of the scenarios and how you can profit. Not only profit, but hedge, protect your portfolio, and in many other ways that I don't have time to show here to generate income, lower costs on stocks that you already own. The flexibility and versatility of options is endless, and it's invaluable. And that is why you need secret number 5 in this volatile market. If you're interested in learning more about how to apply a process and a system, I'd like to introduce you to the Options JumpStarter course, 6 Weeks to Profitable Options Trading. It's a complete step-by-step system that shows you how to buy calls and puts so that you can profit in both up and down markets. We believe here at VectorVest that your system determines your success in investing, whether it's options or any strategy that you're employing. But for our purposes here, we're talking about for options trading. From market direction to finding the correct underlying stock, to be able to know how to set up that trade, and most importantly to me is once you're in it, how do you manage the trade once you're in? Well, we help put together that process with our Options JumpStarter course. These are the 6 modules that are found when you sign up in the VectorVest University. In this course, we start with the Options Foundation Builder, laying the foundation for those who may be new to options, and then we talk about, as I talked about here, setting up trades for bullish markets and bearish markets. We'll delve deep into trade selection, trade management, and then finally we'll talk about actually executing your trades with different brokers, how you set that up, and finally the trading checklist. If you join and choose our Mastery package, not only do you get the 6 modules, but we have 6 live Mastery support sessions that we offer as well. We'll meet each Wednesday at 11 a.m. starting June 15th. We'll implement what you learned in the module recordings. We'll look at what you're doing, help guide you. And if you can't make it, don't worry. We archive that recording later that afternoon so that you can see in real time what we did that day. Go to www.vectorvest.com/jumpstart to register for that. When you do, it'll actually bring you to this page. I urge you to come to the registration page here. You can just click register, but before you do, you can get a great overview of what the course is all about, what we offer here. The regular value is $7.95. We're going to offer you a better price for that. right? We have a bonus price right now, $4.95 for our this is the Mastery package, and we've got some great testimonials that folks who have taken the course will share with you. So simply come to vectorvest.com/jumpstart, click on the Mastery package registration, and you'll see that price, which is available to you until Monday at 5 p.m. So thank you for taking the time, and I look forward to seeing you next time.